Today's guest is one of the most esteemed, celebrated, and legendary business moguls, investors, and financial commentators of our time. He co-founded the Quantum Fund, one of the world's first truly global funds. He's created his own commodities index, his own ETF, and he is a popular author of a great many books. Welcome back for your third appearance on GRE, Jim Rogers.
Well, Keith, there's no reason to go into all that. I'm just a simple person.
Well, that's why people like listening to you, because you're rather plain spoken on what some people deem to be some pretty complex concepts. So it's good to have you here, joining remotely from where you live in Singapore. And you were here with us in both 2019 and 2021. And in 2019, here on the show, you said, and I've got the quote right here, if you can borrow a lot of money for a long period of time at low interest rates, rush out and do it right now. That's what you said. That was prescient. And also in 2019, here on the show, you said, and I quote again, interest rates are going to go much, much, much higher over the next few decades, and it is going to ruin a lot of people. And here we are today. So what are your thoughts with regard to interest rates and inflation here, Jim?
I make many mistakes. Please. I make many mistakes. And I'm sure I will make I hope I live long enough to make many more mistakes. Yes, interest rates are up, and they're up substantially since then. But Keith, it's not over yet. Interest rates will go much higher because we have printed, not just we, but central banks everywhere have printed huge amounts of money. And whenever you print lots of money, inflation comes, interest rates go higher. And if you print huge amounts of money, inflation gets very high. And that always leads to central banks having to raise interest rates to high levels because they don't know what else to do. In 1980, before you were born, interest rates on simple U.S. government treasury bills, 90-day treasury bills, interest rates were over 21%.
Gosh.
That's not a typo, 21%, because inflation was out of control and we had to take drastic measures. We may have to do something like that again.
Well, that would be interesting. So to bring us up to where we are right now, the federal funds rate has basically gone from 0 to 5% since last year. Mortgage rates rose from 3% to 7% just last year alone. And a lot of nations are jacking up interest rates. I mean, Turkey just decided that they are going to raise interest rates 6.5% all at once. And some people don't think that that is enough. So here we are. I mean, you talked about what happened about 40 years ago. Can Jerome Powell engineer a soft landing? Does he have any chance of doing that, where he can raise rates enough to quell inflation, but yet not crash the economy?
No, of course not. I mean, first of all, in 1980, America was still a creditor nation. Now we're the largest debtor nation in the history of the world.
Yeah.
The debt's staggering and they go up every week. No, and the amount of money that's been printed is beyond comprehension. I don't know how they can solve this problem without really getting drastic and taking interest rates to very high levels. Back in 1980, the Federal Reserve had the support of the president. The president told him to do whatever you have to do. The head of the central bank was named Paul Volcker, who was a smart guy, and he knew what he had to do. But he made sure he had political support before he did it. Now, the president did not get reelected because Volcker did what had to be done. We don't have as smart a central bank head now as we did then, and the amount of money that's been printed is overwhelming. And America's debt, we're the largest debtor nation in the history of the world, and we were a creditor then. So there are things that are different. So Keith, I would be worried if I were you. In fact, I am worried, so I'll leave it to you, but I'm worried.
Well, that's right. Carter was a one-term president. We'll see if Jerome Powell ends up breaking too many things, if Biden only ends up being a one-term president then as well, whether it's his fault or not. Oftentimes the onus could fall on him. And you bring up all this debt, the greatest debtor nation in the history of the world. And maybe the first time you and I spoke back in 2019, I don't know what our debt was then. Maybe it was 25 trillion. Now it's more than $32 trillion. Maybe just as concerning and more, our debt to GDP ratio is about 121%. So I guess really what I'm getting at, Jim, is how will we know that things break? And things are already breaking in a world of higher interest rates with failing banks and more stress in the commercial real estate market. So what else is going to break?
Jimmy Carter did say to Volcker, do whatever you have to do and I will support you. I doubt if Biden would say to the central bank, do whatever you have to do and I will support you. And I doubt if the central bank, the Powell, the head of the central bank now, really comprehends what he's gotten us into. You know, he kept saying all along, oh, don't worry, everything is under control. The Secretary of the Treasury, Janet Yellen, who's got Ivy League degrees, also kept saying, don't worry, everything is under control. We know what we're doing. We do have different people this time. There's not many Paul Volckers that come along in history. The indications are it's going to get, to me, the indications are it's going to get worse. And they will not solve the problem until we have a very, very serious problem. I'm not optimistic. Having said that, Keith, I'm not selling short or anything else at the moment. I'm worried about the markets in a year or two, but at the moment, since nobody seems to understand what they're doing at the Federal Reserve or in the presidency, we can have okay times for a while. But the ultimate problem gets worse and worse and worse unless you deal with it.
I don't know whether the economy has been slowed down enough yet or not. So, in the midst of higher interest rates, we continue to create an awful lot of jobs, but there's a greater body of work that shows a lot of these jobs are just jobs that have recovered that were lost in the pandemic.
The economy is not bad in the U.S. The economy is still strong. You mentioned jobs. We still have a lot of jobs, etc. Yes, we have inflation, but inflation is not as bad as it was in the 70s, for instance. So and you look out the window, Keith, and everything seems okay at the moment. I'm just worried about what's coming down the road because I know that from throughout history, if you print a huge amount of money, you create big problems.
Well, we are avid real estate investors here, directly investing in real estate. And as we have this chat about inflation and interest rates, as real estate investors, ideally, we would have low interest rates and high inflation. However, those two are positively correlated. You typically have both high interest rates and high inflation, or low interest rates and low inflation, that positive correlation.
Inflation always in the history has led to higher interest rates for a variety of reasons, which I'm sure you understand. And if history's any guide, interest rates are going to go much, much higher eventually. And as you know very well, high interest rates are not good for property, not good for real estate investors. They never have been. Even if you don't have any big debt and you don't have debt problems or mortgage problems or anything, maybe your neighbors do. And if your neighbors have problems, that means their property prices will go down, and that's going to affect you because you're nearby. And everybody will say, oh, that property is collapsing. What about Keith? And Keith can say, oh, don't worry about me. I don't have any debt. They'll say, okay, you don't have any debt, but we can buy property in your neighborhood very cheap because your neighbors have problems. That gives you a problem.
That's right. And fortunately, Americans have plenty of protective equity in their properties. Despite these higher rates, residential real estate here in the second half of 2023 is still doing just fine, probably because there's still a scarce supply of residential real estate. And you've got more people working from home, driving demand for residential real estate. But of course, office real estate has probably been hit the worst, crunched by high interest rates and the work from home trend both. So really, that's where we've seen so many of the cracks in the real estate world, especially around the office space. Where else might we see cracks as interest rates continue to go higher like you think they will?
Well, again, throughout history, when interest rates go higher and higher, it attracts investors and money and people take their money out of property or stocks or whatever. to put their money in safe, high-yielding instruments. You can buy government treasury bills at 21%. That's attractive to a lot of people because it's, risk-free and it's very high return. So as interest rates go higher, it attracts money from other investment classes and other areas. It's pretty simple. I mean, people are not that dumb. We know that if we can get high interest rates safely, we'll do it. And if we have to take a risk in the stock market or something else, we're less likely to do it.
Sure. Higher rates just incentivize a few more people to be savers as they can now safely get, 4% in these online bank accounts today, where they were getting pretty close to 0% just a couple years ago. And we talk about real estate investment. Oftentimes here we talk about improved property on a piece of land. But of course, the more traditional use of real estate is growing crops on a piece of land. And I know you've been a longtime agricultural investing enthusiast and a thought leader in agricultural real estate investing. So, what are your thoughts about agricultural real estate since in these past few years, really we've seen more of these erratic weather patterns that have resulted in things like reduced peach yields in Georgia and reduced orange yields in Florida. And something else, Jim, we've seen reduced coffee yield in Panama. That last one, that's sort of a fractional ownership investment that we featured on the show here. Fractional ownership investment in coffee farm parcels in Panama. That's created some problems with their yield. Of course, you can see that reflected in the low levels of the Panama Canal as well, that looks to threaten the economy. But what are your thoughts about agricultural real estate in this erratic weather that we've had? Perhaps that's an opportunity if that's reflected in lower agricultural real estate prices.
Well, I'm optimistic about agricultural land prices because, agriculture has been a disaster for a long time, Keith. Nobody wants to be a farmer. The average
Right.
age of farmers in America is 58. The average
Gosh.
age of farmers in Japan is 66. I mean, I can go on and on. The highest rate of bankruptcy in the UK is in agriculture. So agriculture has been a disaster worldwide for a long time, and disaster usually leads to great opportunities. If you know how to drive a tractor, maybe you should go buy yourself some farmland and become a farmer. If you like getting hot and sweaty every day, it can be a very exciting way to live. I know that from history, when something gets very bad for a long time, it usually leads to a great opportunity.
Well, you are so experienced in commodities trading, and the number one, the most traded commodity in the world is oil. And it seems that the oil price really isn't very high now, especially when you adjust that for all the inflation that we've had the past few years. And of course, the oil market and the oil price drives the prices of so many other downstream products. So, what are your thoughts with regard to the oil market and where we're headed there, Jim?
Well, I know that known reserves of oil have peaked and are in decline just about worldwide. Doesn't mean it has to continue going up, but unless somebody finds a lot of oil quickly in accessible areas, the price of energy undoubtedly will go higher. The price of energy is going to stay high, oil and natural gas, whether we like it or not. And I know we don't like it, but unless you wave a magic wand, and in Washington they keep doing things that they don't help the supply of energy. They damage it because they put restrictions and controls on energy. So unless something happens somewhere in the world pretty quickly, energy is not going to be cheap in our life.
Renewables like solar and wind may be the future, but oil has a high degree of energy density that a lot of those renewables still don't. We're talking with legendary investor Jim Rogers. He's joining us from Singapore. You talked about all this dollar printing, which has created inflation. And in order for central governments and central banks to get more control over people, discussion with CBDCs, central bank digital currencies, has really percolated quite a bit in the past few years here. And with your international perspective, your worldview, I'd like to know what your thoughts are on CBDCs, whether you see a proliferation of it, where you see it starting. And for those that aren't aware of it, central bank digital currencies, that gives a government central control where all money is digital, issued by the central authority, where your money can be stored digitally on your phone so that a central authority, like a bank or a government, can have control over you. For example, if your local economy is sagging, well, the government could tell you through your CBDC, your central bank digital currency, for example, that you need to spend 30% of your income within a 10-mile radius, or else your money expires. Or this would give central authorities power to do something like, say, there's a curfew, so you can't spend any of your money after 9 p.m. Or this is where they could push ESG, environmental, social, and governance agendas through targeting your spending, or targeting your spending through DEI, diversity, equity, and inclusion, and getting more control that way through CBDC. So what are your thoughts with the proliferation potentially of CBDCs, Jim?
Well, we're all going to have digital money in the future, whether we like it or not. It already happened. I mean, China is way ahead of us. You can't take a taxi in China with money. You have to have your digital money, your phone money.
Yeah.
You can't find ice cream in China with money. And so it's happening, and nearly every country is working on computer money. Let's call it whatever you want to, computer money. And governments love computer money. It's cheaper, it's easier. They don't have to transport it. Oh, they love. But mainly they love it because of complete control over all of us, as you point out. They know everything you do. They'll call you up one day and say, Keith, you've had too much coffee this month. Stop drinking so much coffee, whatever it is. They love control and they love knowledge. I don't, but they do. So this is the world we're coming to. None of us will have money in our pockets except on our phones. And yes, that's the new world. It's not far away. It's not here in 2023, but it's certainly here in this decade. Anything that's not good for the citizen, Washington will catch up very fast if it's good for them. So, no, digital money's coming.
Let's hope the CBDCs don't turn off the coffee for anybody. Well, this might make one wonder, what can they do about it as you see more CBDC sentiment building in other nations with them potentially doing something like this? Is it a smart thing then for someone, rather than store dollars to instead borrow dollars by having loans on real estate? Or is it better to just completely be out of the government system of currency issuance, or at least park more of your prosperity outside of the government system of dollars and euros and pesos and reals and yen, and instead into a non-government alternative like gold or Bitcoin? Would that be a better path? What are your thoughts there?
Well, when the government says, okay, now this is money, they're not going to say, okay, but if you want to use that money over there, you use their money. We don't care. Governments love control and they love monopoly, especially when it comes to money. So there may be competing types of money. We use US dollars now, Americans anyway. I guess you and I could swap gold coins or seashells or something if we wanted to. Most of the people in the US use government money, and that's the way it's going to be. Whether we like it or not, the government has the monopoly, they have the guns. And if you can say, all right, I'm not going to use government money, they'll say, okay. But you're not going to be able to pay your taxes in your money. You're not going to be able to buy a driver's license or pay your other fees with other money. You're going to have to use government approved money.
Will the government try to shut down ownership of gold like they did previously, or Bitcoin, which would be unprecedented? I'm talking about the United States government, especially in this case, or other developed economies.
But when the U.S. took away the right to own gold in the 30s, that was when gold was the basis for the monetary system in those
Right.
days. It was much, much, much more important to the world economy then. Contracts were written in terms of gold, everything written in terms of gold. So they thought they had to do something strong. Gold is not that important in the world's economy now. It's important, but so is rice, so is a lot of stuff. So I doubt if they will take gold away again. So I don't see them outlawing digital money currency unless it becomes very successful and competitive to the government. Then they'll do something. They always have.
Bitcoin's market cap is still under $1 trillion, but increasingly you do have more and more politicians that own Bitcoin, and there are a few advocates for Bitcoin there in Congress. So if that's the change you want to see, maybe you want to vote in people that are promoting the holding of prosperity outside of US dollars, really by being Bitcoin advocates in Congress there. That's one thing that you can possibly do. But when we talk about gold and silver, I really like the fact that it is scarce, just like Bitcoin has scarcity. There will never be more than 21 million Bitcoin. And of course, gold and silver have a finite supply.
Well, but first of all, please remember many digital currencies, not Bitcoin, but many have already disappeared, gone to zero.
Yeah, I know there are some Bitcoin critics out there that say something like, well, there have been more than 20,000 cryptocurrencies. So what makes Bitcoin any better? Well, I think the fact that a lot of these cryptocurrencies that have little or no utility or meme coins, if they come by and then they die, I don't think that should diminish Bitcoin and its utility in any way. Just like there have been over 20,000 stocks in history. And if a new stock comes by that doesn't have any valuation or any fundamentals and it fails, well, it doesn't diminish the market cap leader, Apple, one bit at all. So yeah, I don't think it's a valid comparison to say that just because a new cryptocurrency comes and goes, that shouldn't diminish or knock Bitcoin at all, just like it shouldn't Apple if a flashy new stock comes by and dies.
Well, throughout history, money has come and gone. People use seashells, people use cows, people use lots of things for
Glass
money
beads.
all over the world. The U.S. was founded on a silver standard. Act of 1792, silver was the basis for the U.S. currency that later changed to gold.
What's so interesting, Jim? Written in our United States Constitution, it stated that gold and silver shall be money. But of course, it's not. And Nixon completely depegged the last vestige of that in 1971. Yet there was no amendment written to the Constitution to supersede that gold and silver shall be money. So when it comes to currency and how one measures the prosperity in the United States, it is the dollar. We know it's going to continue to be the dollar for some period of time yet, and you can't get too many certainties in investing. And then really the second near certainty we can get is that the dollar is going to continue to diminish in value. So that's why rather than save it, we borrow for real estate. Well, Jim, wrapping up here, in this world of higher inflation, though it's come down, and higher interest rates, where you tend to think they will keep going higher, what should one do? Maybe especially a younger person today, any direction that you would have for a younger person, a younger investor, or maybe that's even investing in themselves and developing skills themselves. So what are your thoughts there?
Well, all investors, young, old, whatever, should invest only in what they themselves know a lot about. If you want to be successful, don't listen to somebody on the TV or in the magazine or even on the internet. You, your program. They should invest only in what they know about. If you listen to somebody and she says buy X and you buy X and X goes up, you don't know what to do because you don't know why you bought it. Or
Right.
if X goes down, you don't know what to do because you don't know why you bought it. So if you want to be successful, just stay with what you yourself know a lot about. And you may say that's boring. Be boring. If you want to be successful, be boring. Invest in what you know. And I cannot tell you how important that is for all investors, young or old.